Welcome to the Independent Advisors Podcast, where we dive into the world of stocks, tradable markets, and financial planning with Jessup Wealth Management's Chief Investment Officer, Mark McEvily, and CEO, Matt Jessup. You'll hear tips, tricks, and strategies to address your financial well-being and, most importantly, conveyed in a way that everyone can understand. Here are your hosts, Mark and Matt.
Hey everyone, welcome to episode 230 of the Independent Advisors Podcast, where Matt Jessup and I, Mark McEvily, bring you everything you need to know from the past week in the world of financial markets and financial planning. This week, Nick Whitaker, our Director of Research and Trading, back filling in for Matt. So Nick, thank you for joining us again this morning.
Always great to be here.
Yeah. So we got a lot of info to cover this week for listeners. So we'll just go ahead and hop right into it, with there only being about 16 full days left, calendar days left in 2023. As always, we're going to quickly review the month-to-date and year-to-date performance of the major market indices that we track, and this data is from Y-Charts and as of the market close on December 13th. S&P 500 index is up 3% for the month and up 22% for the year. The Dow Jones Industrial Average up 3.2% for the month and up almost 12% for the year. The NASDAQ Composite Index up 3.5% for the month and up 40% for the year. The Russell 2000 Small Cap Index up 7.5% for the month and almost 11% for the year. And the Vanguard All World X United States ETF up a little more than 2% for the month of December and up 10.7% for the year. 3-month Treasury rate sitting at 5.44%, the 2-year Treasury rate at 4.46%, and the 10-year Treasury rate at 4.04%. Moving on to big headlines, current events from this week, Nick. Kind of a lot going on in terms of inflationary data, the Fed announcing their interest rate decisions. So just yesterday, the Fed decided unanimously to leave the target range for the benchmark federal funds rate, which is the rate that other institutions use to set interest rates in this country, between a range of 5.25% and 5.5%, which remains the highest, target range since 2001. And the Fed Chair Jerome Powell said that they discussed the prospect of easing policy, for example, lowering interest rates for next year. And it was shown that 8 Federal Reserve officials saw fewer than 3 quarter-point rate cuts next year, while 5 Fed officials anticipate more than 3 rate cuts next year. So, going to be interesting. Like I always say, does no good to try to predict what the Fed is going to do, because most of the time people are wrong. So
It'll change between now and then.
Yeah, for sure. But at least for right now, looks like inflation is under control, and for the time being, doesn't look like interest rates are going to move any higher for now. Bigger news that I think listeners probably going to be more interested, Nick, than the boring old Fed, is that the Dow yesterday, Dow Jones Industrial Average, that is, hit an all-time high for the first time since January of 2022, which is 707 calendar days ago. So this was one of the longest periods in history, actually, that the Dow went without making an all-time high. It's like the top 12 or 13 longest periods without the market making a new high. And that happened yesterday, obviously, after the Fed had a more dovish or easy rate policy speak yesterday, obviously after their rate hike their rate decision. So market closed very strong yesterday. And I thought it was interesting, Nick. I run certain scans every single day and a couple every single week after the market closes and before the market opens. And yesterday, 271 stocks in the S&P 1500 made new 3-month highs, but those are only stocks that meet our firm's proprietary filters to be able to invest for clients. Because I don't even want to
Mhm.
look at stuff that we can't trade because there's no volume or it's too small of a
Right.
company.
Yeah.
So that really, the S&P 1500 is, roughly 1500 names, but with our filters, that probably almost gets it to cut in half, maybe
Yeah.
seven to
Yeah.
900.
Yeah.
So we have 271, let's just call it, out of 800 stocks making new 3-month highs, and then also 231 stocks making new 1-year highs. And these are numbers that we have not seen, I can tell you, because I run these every day and every week, in a very, very long time. So it is good, again, to see market breadth uh, get better and get healthier, meaning there are more than just a handful of stocks participating in this upward move. So this week has been pretty positive action so far, especially heading into the end of the year.
I'm gonna steal one of Matt's favorite lines and say that's not bearish.
Correct. Very, very true. So, yeah, so it's been a good week. Hopefully, we can carry this over into the end of the year. But unless you have anything else, Nick, we'll go ahead and move on to tweets, articles, and research for the week.
Oh yeah, let's jump into it.
The first thing I had was a just a snippet from a blog post from our friend Ryan Dietrich on December 7th. And he kind of discusses some things that have bulls smiling. That's, the when we're in good times, that's kind of his stick is, here's a bunch of reasons why bulls are going to continue to smile. People that are positive on the stock market,
Mhm.
right? So we said the S&P 500 added an incredible 8.9% last month, which was November, which was the 18th best month ever in the S&P history since 1950. Here are the previous top 20 months ever and what happened next. The good news is higher a year later, 80% of the time, and up another 13.3% on average. Could have a lot of bulls smiling in 12 months. So Jenna will throw this up on the YouTube page, this chart, and in our show notes. But what it shows is, the best 20-month gains for the S&P 500 and what happened over the next 1 month, 3 months, 6 months, and 12 months. And obviously, the further you go out, the stronger and stronger the returns get. So this is a situation, in my opinion, Nick, of strength begets strength. And just because the market is having a great year this year, that doesn't mean it can't have another great year next year. It's not a situation where we have one good year and one bad year, and we go to one good year and one bad year. That it's not how it works, right?
Mhm.
So strength, actually, in my opinion, is a better thing than seeing for future performance than having a year where markets are down slightly.
Mhm. Yeah,
So
I'm looking at the data. It's interesting seeing a number of months from the past 3 years that are that made this chart. When you think
mhm.
of the context of history, that's shows how much volatility's been rampant in the market over the past couple of years. It's interesting.
Yeah,
See the
so I
2000s are in there quite a bit, and then the 80s as well. That checks out. The 70s where inflation was high. That checks out to me
right.
as well. So that's kind of interesting.
Yeah. So again, just because it's been a good year so far, that does not mean that 2024 is going to be a negative year. It could, but doesn't
Yeah.
mean that. Second thing I had, Nick, was a blog post from Ben Carlson, also on December 7th, titled "What Happens After a 20% Up Year in the Stock Market," kind of relating to what we just talked about. But he said a reader uh, sent them an email and said, "Sure, it's great the S&P 500 is up 20% this year, but aren't we just pricing in the inevitable Fed rate cuts in 2024? Question mark. Should we really expect the market to go up again next year after surprising to the upside this year? Color me skeptical. Full disclosure, I'm naturally bearish," which I think most people are naturally bearish, which
Yeah.
doesn't make any sense to me. But anyways, And he posts a chart that Jenna will throw up now for listeners and viewers. But he says, here are all the 20% up years along with the following year returns. So similar to the chart that we just talked about and we just saw, but it just outlines every year the S&P 500 has been up 20% and then what the next year has done. So quick summary stats for people who aren't looking or watching this on YouTube. The stock market was up 65% of the time following a 20% gain. The stock market was down 35% of the time following a 20% gain. The average return following a 20% up year was 8.9% the following year. There were 19 double-digit up years and there were 2 double-digit down years, and that was in 1936 and 2022. So again, another piece
And
of information that's the strength begets strength
and
argument.
a lot of those down years, they I mean, I get it, it's a down year. You always want the market to go up, but they're not vicious down years. It's more kind of trading sideways when you look at it on
Hmm.
just a number basis. I see 2 1%,
A lot of single digits.
4.7, yeah, 4, 3, even like the 7, 8, 8, 8. There's another one in there, 9. That's not in the grand scheme of things. That's not that shouldn't scare listeners.
People. All right.
You're in this for the long game. If you made 20% last year and you lose 9% the next year, you're still up net 10% over the
Right. And
past
I'm
two
looking at
years,
like
right?
1933, like the market was up 50% and the following year was down a little more than 1%. So it's like, we'll take that,
We'll
right?
take that. Yeah, yeah. And that's like investing is the long game. You always have a strategy, and yeah, there are times where you need to get more conservative for your personal financial plan. But in the grand scheme of things, these numbers are even more encouraging. I would say that 65% of the time, I would put an asterisk there because when the market a year later is basically trading flat and you're going to have volatility in all of these years, of course, but like when you end flat or mid single digit loss after a killer year, I think that's normal. That's
Yeah.
healthy.
Yeah, I would agree. Um, Last thing I had, Nick, was a quote from Art Cashin, who is a managing director at UBS. He says, quote, never bet on the end of the world. It never ends. And if it does, who will you settle the trade with? End quote. And I love this, Nick, because a lot of times we get
Uh,
every year we get this, right? We get questions from clients saying, hey, for example, the government can't sustain the debt. The debt is getting out of control. Eventually, the economy is going to collapse. The system's going to come down on itself. Or, the US dollar is no longer going to be the world reserve currency. And yeah, it's very, possible that eventually those things happen. But their question is, how do I protect my portfolio against that? And my question or my answer is, if those things happened, we'd have a lot bigger problems on our hands. We would have anarchy, right?
yeah,
And I think
yeah,
one of the last things people would be concerned about is their investment portfolio.
yeah,
So if you think that the world is going to hell in a handbasket, um, it doesn't really matter what happens because money is going to be obsolete at that point. So in my
yeah,
opinion, it doesn't really do much good to prepare for that type of stuff. Because if the market ceases to exist, then it's
yeah,
just complete anarchy. So I never like really, getting into that. Obviously, we have certain things in place for client portfolios of, when we get more conservative, when we add risk, when we cut risk, that type of stuff. But um, the world's going to end, then, none of this matters what we're talking about.
So it's an excellent point. It's very well said. It's kind of some of those conversations and some of the media out there, they really try to stoke fear and anxiety and panic and I get it. They have a job. They're selling clicks essentially, right?
Yep.
And ads, which they need clicks for ads.
Hmm.
Um, but some of the stuff that's out there, all of those things happening at the same time and the system, quote unquote, collapsing, it just seems incredibly far-fetched. Like you're saying, and
Hmm.
I'll throw another scenario out there. It's like alien invasion. If an alien invasion happens, you know, oh, yeah, you're
None of
gonna,
this
yeah,
matter. I mean,
I
yeah,
mean,
and it's the
if
same thing. It's like if you take all your money out of the stock market and you have it all in cash at your house, for example, it's the same conversation, because if the system collapses, then like money is not going to be able to buy you anything anymore, right?
yeah,
It's like
the aliens
so
come
it's a
down and are zapping us all, yeah, their portfolio that doesn't, yeah, it's not
doesn't
gonna
matter. Yeah,
do a lot. So there's definitely something to be said about, planning for the worst case scenario. When
right.
we talk about worst case, we're yeah, it's like you said, we can't plan for those types of doomsdays. It's just not feasible. And
Right.
it's also not like fiscally irresponsible, which is a big part of our
Correct.
job, of course, where we
Correct.
can't say, oh, there's a 10% chance that the entire system, that's not, we can't, there's no data for that.
No, no.
So,
Yeah,
yeah.
so that's all I had. Eventually, at another time, would love to get your 2 cents on the alien conversation, because
Oh,
that's
yeah.
always an interesting one. But we'll save
Oh,
that
yeah.
for
Yeah.
another day.
Well, I have a couple charts here. So all of my items this week, which is a little different, are going to come from one piece of research from Y Charts, which is our research software, one of the many research softwares we use. And they sent around a brief the beginning, I guess it was a week or two ago, with the top 23 charts of 2023. So charts about the market and the economy that kind of summarize the year. And I went through and was reading it, and I thought some of it was a pretty good recap for listeners. And we're getting to the end of the year, so I picked out four market charts that I thought summarized the market pretty well, and just things to remind listeners. There are two charts in here, so we'll run through these four charts, see what you think, and kind of remind listeners about what happened this year, and that's what I have this week. So the first chart, which Jenner will throw up here, is the SPY, which is just an ETF that tracks the S&P 500. It's the percent off of the high. And the main reason that I wanted to throw this up for listeners is what you were talking about with the Dow Jones, where the Dow Jones made a new high last week, and it's just like that's amazing because it's been a while. And I think I think that's kind of has flown under the radar for the average listener. You know, it's been a tough couple of years, and we're still making our way back, and the market will make new highs. It did throughout history. It has continued to do so. So it's a good chart just to remind listeners of kind of what we've all been trudging through over the past 2 years of volatility. So, what are your thoughts on that one?
Yeah, I think it goes to show you that, looking back at this year, again, like it always does, right? And at the end of October, things felt a lot worse than they actually were. At the end of
Mhm.
October, the market was only like 14 or 15% off of its all-time high, right?
Yeah,
Which,
yeah,
if we take a step back and view it through the lens of that, it's like, God, what were people freaking
yeah,
out about, right? So I think this is a good chart, because it really goes to show that, this whole year we really haven't been that far off of all-time highs. It looks like,
yeah.
the farthest was right in the beginning of the year,
Mhm.
when we were a little more than 20% off the all-time high.
Yeah.
So yeah, it's just interesting, because it kind of flips the performance of the
Yeah,
markets on its head, and it's looking at
yeah,
it from the opposite view of, okay, well, instead of how the market is done this year in terms of a percentage return, how far off highs
Yeah.
are we at any given point in time? And that's why, I really like Y charts specifically
Yeah.
for this. This is probably one of the most popular forms of charts that I pull up is
Yeah.
on an individual security level or a market level to see how far these securities are from their all-time highs.
Yeah. These a lot of times people will call these like drawdown charts.
Correct.
Um, so yeah, I think when you look at that, look at COVID, down almost, we'll call that 34% from the high. That felt pretty tough. That was pretty scary.
Yeah, that
Just how
was.
quickly it fell and
Hmm.
how much AUM was wiped out of the market in such a short time. It's good to kind of look at this and remind ourselves this is all normal activity. So
Yeah, and the last thing I want to add to this, Nick, is we use these type of charts when we're talking with clients about risk tolerances and investment objectives, right?
yeah,
Because if someone says, "Hey, I want, the return of the S&P 500, but I can't handle more than a 15% drawdown," right? We could easily pull out this chart and be like, "Well, that's just not possible," right?
it's unrealistic.
It's
Yeah,
unrealistic,
it's
and you
yeah,
can do that with different types of strategies and combining certain strategies and saying, hey, what are your goals, what do we need to average in terms of return over the next 10, 12, 20 years, and let's see, hey, what is the drawdown or the percent off of the all-time high been, the max percent off of the
yeah,
all-time high, and is that something that you think you can handle, with the caveat in mind that the largest drawdown is always in front of you, because you could
yeah,
back test a system that has only experienced a 10% drawdown for the past 20 years, and you have to fully expect that at some point in the future that specific investment strategy is
yeah,
going to have greater than a 10% drawdown, because there's just no holy grail.
yeah.
So very important thing to keep in mind.
Yeah, an excellent caveat. An excellent caveat. The next few charts are a little bit kind of simpler performance charts, just as again, a reminder of kind of what's happened this year. And so the next one is a 2023 sector performance, and this shouldn't come as a surprise to listeners who tune into the market pretty regularly. That your top sectors this year have been tech, communication services, and consumer discretionary. I think that's they got out to a pretty good lead in the first half of the year, and they trended a little bit lower, those three sectors, but for the most part, they've kind of hung in there
And
in their outperformance. So,
yeah, and it's expected, right? During a
hmm
during a bull market, you expect tech, communication, discretionary, industrials to be the top four. Maybe
yeah, yeah,
industrials
yeah,
and financials would be switched around, but this is what you would expect, and this is what you see in periods of strength. Which it's always just, I know we touched on this a little while ago, but it's always just funny to look back on a full year, because at
yeah.
certain points during the year it doesn't seem like it was that easy, right? Like
No, no,
Matt
it's
always says, hey, if you went to sleep on, January 1st and woke up on December 31st, you'd be like, 2023 was a
was
walk in the park.
easy. Yeah.
Yeah. But
No,
you
it's
know,
constantly stressful. It's
yeah,
there's always going to be questions. I mean, even think about the end of October, like you said.
things
Man, there
felt
was there
dire.
was
Yeah.
yeah, there was stress in the markets. People were worried, and look what happened in November. Stocks almost immediately, November 1st, the whole market just started climbing. So yeah, it's not easy. But mm, that's the market, right?
Yeah, exactly. Exactly.
The no pain, no gain kind of thing. That's
Correct. It's
there
true.
is uh to get the reward, you have to kind of go through some of the volatility and some of the pain, and then look back in hindsight, and there you have it. So
Right. Right.
the next chart I have, which is something that's definitely circled the newsrooms over the past few months for sure. It's getting a lot of attention, I think for good reason. Is a chart of the S&P 500 versus the S&P 7, and then basically, so like the top seven companies in the largest seven
Hmm.
and the S&P 500, and then the other 493, and it breaks out those performances year to date across those three categories. And you can see pretty overwhelmingly that the market has been dominated by the top seven names in the S&P 500. Um, what are your thoughts on this? I'll toss it to you. I have a
Um,
couple, but
well, I think the first thing is that the biggest question I think that's out there, it's like, why do we bother holding any other stock other than the Magnificent Seven, right?
yeah,
So Apple, Amazon, Google, Nvidia, Facebook, Tesla,
Mike,
Netflix, Microsoft,
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 yeah,
Microsoft. Um, and my answer to that is always very easy. It's okay. Well, 2023, yeah, it'd been a great time to hold the Magnificent Seven, but in 2022, the peak to trough declines in Google was down 46%, Amazon down 56%, Nvidia down 66%, and Facebook down 77%. So, I'll touch on this at a later podcast date, but from research I'm reading, an equal weighted portfolio of these seven stocks had a 48% drawdown in 2022.
easily,
And
yeah,
just
easily,
to
yeah.
put that in context for people, that's like what happened in the great financial crisis.
Hmm.
So
It's way
again,
worse than COVID.
right, it long term, like these stocks have done great, but you're going to have to sit through some pretty big drawdowns like we just talked about in one of your previous charts, Nick, that
Hmm.
not a lot of people can handle that. I don't know if I could handle that, you know. Typically
It's
when you hear
yeah,
someone say I can deal with a 20% pullback, it really means they can deal with a 10% pullback. Um,
yeah,
so it's not the things you read in the media may make it seem like, you know, all you need to do is hold these seven names, but we don't have to look that far back to
yeah. Look,
a
one
year
year, yeah,
where these names got just obliterated.
yeah. Yeah, that was going to be one of my big points is okay, like why did this happen? And it's because they were obliterated last year,
Hmm.
like you said, the drawdowns were fierce. Um, and I think they just kind of came back to life.
Hmm.
And a lot of that has to do with big institutional money, um, pulling out of the stock and probably going to cash in 2022 and sitting on the sidelines. And they're going to pull it from the biggest, most liquid names, and those names were getting crushed. And then 2021 starts, and clients eventually are going to, okay, we got to put cash to work and put more cash in the system. Where are you going to put it? Going to put it back in some of those liquid names. I think that's a piece of it. And then I think there's this phenomenon which we've probably talked about at some point in the podcast, in podcast history. I'm not 100% sure, but the phenomenon of the the tech safe haven trade, which is kind of counterintuitive and a bit of an oxymoron, but it has been a real thing over the past 5 years where at times of stress, not always, as we saw in 2022, which is why this is not like a guaranteed thing. But sometimes you'll see a little bit of an equity kind of flight to safety where some capital will rotate into some of these top big, magnificent seven names just as a place to hide out while
Yeah.
they're, figuring out the next move. So I think you could have a little bit of that going on in there throughout parts of the year where you think back to the summer and are we ready to go small cap yet? No, probably not. Like people are strategizing. There's still a ton of bears on the street. I mean,
Hmm.
if you pull up podcasts from this summer, I'm sure we had plenty of charts that were still talking about the sell side and some of the bears. I mean, I know Morgan Stanley was still calling for the year to be negative back
Yeah.
in the summer. So you think about those types of narratives that are going on, and I can see how it's easier for names for money in the market, for the capital in the system to want to hide out in some of the big names, especially given some of the uh, underperformance of the previous year, right?
Yeah.
That,
Yeah.
hey, you're buying on the dip, right? Think about buying from the drawdown chart. If you're getting those top five names at a discount, 30% discount to their all-time high, and on the valuation side, it's like it's not that crazy relative to
Right.
some of the other areas in the market. It makes sense that people would rotate kind of back into that space, which causes this kind of outperformance. But you nailed the point that uh, the final point there, which is, hey, this is 1 year, but this is not, that this is not an investment strategy that will work for most people,
Yeah.
just from
And
a
and
volatility perspective.
And the other thing, people are like, well, why don't like, at the beginning of the year, let's see what the largest, 10 names are in the S&P 500, and why don't we just invest in those because it makes up the majority of the index and drives most of the returns. And it's like, okay, well, I think Y charts actually went back and tested that, and there have been very few times where you've outperformed if you've only held the top 10 largest names. So
Yeah,
again, one of those situations where just because it's working now doesn't mean it's going to
yeah,
continue to be this way.
yeah. An excellent point. And the last chart I have is something that we have talked about at length. I know you and I have talked about it on multiple podcasts. But a lot of the times we talk about this, we're using historical data, over a period of 50 years or 25 years or something like that, something like that. And one of the reasons I love this chart is because it's recent. You could look at it, it's fresh, it's this year. And so this is a breakdown of the effect of missing the best days in the market of 2023. And you can see how drastic the changes are when you start all the way at the top of the S&P 500 level, and you tear down if you miss the best 5 days, 10, 15, 20. You miss the best 5 days, the return goes down to 7.9. That's pretty drastic.
Hmm.
And so we talk about it all the time of, sticking to your strategy, don't panic. This is the danger of pulling all of your money and going to cash, or, a huge percentage of it and go, 50% going to cash. You miss a couple of those days and you can really be eating into your portfolio's gains over the short term and the long term, because, obviously, the goal of this is to compound over your lifetime as you're saving for your retirement and or saving for your investment accounts, or whatever your plan is. So thought it was a good kind of recent chart to remind listeners on that.
Yeah. Yeah. And like we always talk about, we're going to continue to hammer it home because I don't think someone can hear it enough is sticking to your plan. So
Yeah, it's tough. It's really tough.
yeah, it's harder. Or
I have to catch myself in, some small accounts where I make trades, and,
yeah.
in 2019 I bought some high flying tech
Yeah.
names and they
Oh
got
yeah.
crushed, and
Crushed. Yeah.
I just had to say, I'm just gonna hold on to that, and
Hmm.
I'm just not gonna look at that account for a while, because I know those are good names. I trust those names. The earnings are good. And looked at it a couple months later, still down. Looked at it a couple
Yeah.
months later, still down. It was in the red for over a year, and now it's way up, right? And
Right.
that's the patience. Like we have market professionals, we have to do that too. It's not easy, but it's being patient is the name of the game with this stuff.
Correct. Correct. Moving on to the financial planning topic of the week, Nick. This was an article by Matt Baisden with Plan Corp, and it was titled 11 different types of retirement plans. So this week, I kind of just wanted to bring it back to the basics and just discuss common types of employer-sponsored retirement plans. So this article is kind of broken up into two segments: employer-sponsored retirement plans, and then individual retirement accounts if your employer doesn't offer a retirement plan, for example. So this week we're just going to focus on the employer-sponsored plans. Next week we'll cover the basics of individual retirement accounts, like IRAs, for example. So the first thing that Matt talks about, the most popular one, obviously, is the traditional 401k. So a traditional 401k is an employer-sponsored plan that lets employees contribute pre-tax dollars into a retirement account through payroll deductions. And to encourage participation, some plans have automatic enrollment features that require employees to opt out of participating in the plan, while others require employees to opt in. The maximum contribution limit for 2024 is $23,000 for employees under age 50. Employees 50 and over can contribute an additional $7,500 in catch-up contributions for a total of $30,500. Some pros of 401k plans, Nick: easy to contribute, contributions reduce taxable income, the annual contribution limits are high, some employers can match employee contributions, and contributions grow tax deferred, meaning that when you take that money out in retirement, it's taxed at your ordinary income tax rate. And typically when people are retired, they're not making as much as their high earning years, so the tax paid on that is going to be less.
Yeah, and
um
at most matching is like 3%, I think, is in between
the
like
average.
1 and 3%. Like 3% match if your company does that, and if they automatically enroll you in the system and they're giving you a match of up to 3%, that's excellent. That's really
Yeah,
good.
yeah, for sure, for sure. Some cons or negatives: there may be limited investment options. So usually there's just a handful of mutual fund options that you can invest in, and you can't just go out and invest in individual securities or ETFs, things like that.
Yeah.
Withdrawals are taxable, like we talked about. Employer contributions may not vest immediately. So what I'm seeing, Nick, after talking to a lot of people is, there's a yearly mandatory service that you have to give to the company to be vested in the matching contributions from the employer. So whether it's
Yeah.
1 year, 6 months, sometimes I've seen as long as 5 years to be fully vested with that if you were to go and take another job and move your money out of there. So
Yeah.
that's important to make sure you understand that before you start a job.
It's important, and it's important that you're aware of that at your current job, because if that can actually impact your decision to change jobs, because if you can wait 6 months to be vested, and otherwise you'll lose X amount of
Yeah, and
capital that
sometimes
you've
it's
put in.
yeah,
It's substantial enough to make that decision, so it's very important to
especially
be
if
aware
your
of that.
company has like profit sharing
Yeah.
component of it. So if
Yeah.
your company has a really good year, the company decides to share the profits with all the employees. And that happens in your second year of employment.
Mhm.
You move a job a year down the road, and it actually says in the fine print of the plan documents that to
Yeah.
be able to be fully vested with profit sharing from the company, you have to be there for 5 years, or
Yeah.
whatever it is. So definitely want to make sure we understand that before starting a new job. Next one, Nick, is a simple IRA, or simple 401k, sometimes called. So he says that simple 401k plans are available through small businesses with 100 or fewer employees. As with a traditional 401k, employees can contribute pre-tax dollars up to $16,000 in 2024 to their account through payroll deduction. Unlike a traditional 401k, employers must contribute either a matching contribution of up to 3% of each employee's salary, or a non-elective contribution of 2% of their salary. So this non-elective contribution is regardless of if the employee contributes or not, the employer has to contribute 2% of their pay.
Which is
Um,
super nice.
which is great.
Yeah.
So he says, however, simple 401ks or IRAs are rare. Most small business owners opt for simple IRAs because major providers offer more support for them. Some pros: contribution limits are high, employees are immediately vested in all funds, employer contributions are required, and employee contributions reduce their taxable income. Some cons: the employer chooses the investment option. So, again, limited investment options, withdrawals are taxed, and you have to wait, like 401ks and IRAs, you have to wait until age 59 and a half to make penalty free withdrawals. Two more here, Nick. Next one we're going to talk about is the Roth 401k. So, some employers offer Roth accounts in their 401k plan that allow employees to contribute after tax dollars. In 2024, the limit for all 401k contributions, whether deposited into a Roth or tax deferred traditional 401k, again, is $23,000 for employees under the age of 50 and $30,500 for employees 50 and older. Some pros here, Nick: annual contribution limits are high. And this is a big one. Unlike a Roth IRA, there are no income limits for contributing to a Roth 401k. So we're going to get into this next week, Nick, but with a Roth IRA, if you make a certain amount of money over a certain threshold, the government says you cannot contribute to a Roth IRA. You're not
Hmm.
eligible. But there
Yeah.
are no income limits for Roth 401ks. So this is a way to get after tax money growing, tax free, coming out tax free in retirement into that type of vehicle. Some cons: the contributions obviously don't reduce your current taxable income since they are after tax contributions. And again, there may be limited investment options. Last but not least, a 403b is a tax advantage employer sponsored retirement plan similar to a 401k, but it's only available in schools and 501c3 tax exempt organizations. For 2024, similar to the 401ks, the maximum contribution limit is 23 grand for employees under 50 and 30 and a half grand for employees over 50. Employees with 15 plus years of service may be also eligible for additional catch-up contributions. Some pros: payroll deductions make contributing easy and convenient. Contributions grow tax deferred. Annual contribution limits are high. And some employers may offer matching contributions similar to a 401k. Some cons: again, investment options may be limited, funds are taxed in the year you withdraw them, and accounts are subject to RMD requirements. So 403bs act very, very similar to 401k plans, but it's just for schools and tax exempt organizations. But essentially, for most people, they function the same way. Um, so again, it's always a good year. I think, it's smart to, at the end or the beginning of each year, to kind of review your finances, just do a finance health check, if you will, and making sure you understand all of these different benefits that your employer offers. And like I said, next week we're going to get into some options. For example, if your employer does not offer a retirement plan. So looking forward to talk about those things next week. And Nick, before we wrap up for this week, just want to let listeners know if they want to create their own podcast, please use the promo code Jessup Wealth to get your first month of Blueberry podcast hosting for free. To choose the plan that is right for you, use the hosting estimator on their website. Again, you can receive your first month free with promo code Jessup Wealth, all lowercase and no spaces. Before we wrap up, Nick, again, today is Thursday, December 14th. Markets are overwhelmingly positive again today after the big update we had yesterday. S&P 500 continues to climb towards all-time highs, following the Dow. So overall, been a good week, but just wanted to give you the opportunity to leave listeners with anything before we hop off.
No, I don't. I don't have anything to add. I hope everyone enjoys Enjoys the few weeks of calm before the Christmas rush.
Yeah.
Uh,
Yeah. So hope everybody, like Nick says, enjoys the next couple of weeks before it gets all hectic with food and family and friends and time
oh
off and
yeah.
that type of thing. So, hope everyone has a great rest of the week, and we will see you back next week for episode 231.
Thank you for listening to the Independent Advisors Podcast. If you're interested in hearing more, hit the subscribe button so you can be notified every time a new episode gets released. Feel free to share with friends, family, and follow us on Twitter at Jessup Wealth, Facebook, and LinkedIn. Mark and Matt will continue to share beneficial information on these social media sites. Also, check out the podcast tab on their website. That's www.jessupwealthmanagement.com. There you'll find links to every episode of the Independent Advisors. Have questions or topics you want to discuss on the show? Message us on Twitter, LinkedIn, or send an email with the words questions and topics in the subject line to inquiries@jessupwealthmanagement.com. We'll talk about it right here on the podcast. Certain sections of this commentary may contain forward-looking statements based on reasonable expectations, estimates, projections, and assumptions. Forward-looking statements are not guarantees of future performance and involve certain risks and uncertainties which are difficult to predict. All indices are unmanaged and are not available for direct investment by the public. Past performance is not indicative of future results. This podcast is provided for general informational purposes only and does not constitute either tax, legal, or financial advice. Although we do go to great lengths to make sure our information is accurate and useful, we recommend you consult a tax preparer, professional tax advisor, financial advisor, or lawyer regarding your specific circumstances. Investing involves risk, including the loss of principal. No strategy can guarantee any objective or goal will be achieved.